All right. So questions for further thought, Chapter 5. Number 2. So the rules say that a credit entry is required to increase equity. Explain why an expense account, which is part of the equity, requires a debit entry to increase it. Okay? Credit entry is required to increase equity. Why is an expense account, which is part of equity, requires a debit entry to increase it? Okay? So the expenses is an equity account. Why are we debiting it to increase it? Yeah. Yeah. So anytime we're having an expense, it's a cost of doing business, it's going to reduce our equity. It's going to reduce our overall profitability. So in order to reduce our profitability, we're reducing our capital. In order to reduce our capital, we need to debit our capital account. Okay? And the only way to do that is through, debiting our expense account. Okay? So that's why we need to debit our expenses. Okay, number 3. Explain why there are usually only 1 or 2 revenue accounts, but a number of expense accounts. Why would that be? Why would there be a lot of expense accounts, but only 1 or 2 revenue accounts in an income statement? Okay. Anyone? Travis, again? Yeah, absolutely. So businesses usually only have a few different types of revenue, okay? And some businesses will break down their revenues so that they know specifically how much they're making on product A versus product B versus product C, okay? So they may have several different revenues, but they'll have a multitude of different expenses. Everyone will have, at least rent or some kind of loan expense. If they actually own their own building, they'll have utilities, they'll have phone, they'll have a multitude of other expenses. And why do they have all these other expenses? They could, theoretically, just have one expense account, right? They could just say, these are all my expenses, and lump them all together. Okay, or they could just say miscellaneous expense, $100,000. Okay? Why would they want to even bother breaking out all their expenses? Yeah.
So they can see exactly what they're spending so much money on, so they know where to cut back and where to change things in the next fiscal period.
Yeah. It goes down to what they can control. Okay? So if they know how much they're spending on certain items, then they can better control their spending. Okay? Businesses, as much as they'd like to think they have control over sales, they don't have a ton of... Okay, now it's recording. Okay, so number 6, right? Okay, suppose that you were handed a ledger and asked to determine equity. Describe 2 ways that this can be done. Okay, so I've been handed a ledger, so my T accounts or actual ledger accounts. How do I determine equity? What's one way I can determine equity by looking at the ledger? Yeah.
Can you just subtract your total liabilities from total assets?
Yeah. I can total up all the balances on my assets ledgers, total up my liabilities, okay, and then I can determine my equity from that. What else could I do? I suppose, do you have another way? Okay, so, and number 9, I think it's on the next. No, that's it. Number 7. That's all it goes up to. Okay. Number 9. A business could be quite profitable and yet have a cash shortage. Give one reason why this might happen. A business can be profitable but have a cash shortage. Yeah.
You could have a lot of money in accounts receivable, so you haven't actually received payment yet.
Yeah, you could have poor quality clients, okay? Or you're just not, you're not being very, I guess, forceful in your collections, okay? So maybe you want to terminate your accounts receivable clerk because they're not following up on accounts receivable. True. Okay, so you could have bought more than you really had cash flow for. So either unexpected expenses have come up, and so you're needing to use your cash flow to pay for those expenses. Your machinery is going down, so you're having to pay for maintenance or whatever. You have a lot of accounts payable coming due, and you just don't happen to have the cash coming in. So there could be, on either side of the balance sheet, there could be some issues. Okay. Good. Number 12. Why is it just as important to control expenses of a business as it is to increase revenue? So we kind of talked about that already. In fact, it's more important to control the expenses than it is to control the revenues. Okay. I guess you could make a case either way because you need some revenue. You need some base level of revenue. But I don't care how much revenue you're making, you could still blow it all, right? I talked to my planning class about this yesterday, and we were talking about celebrities going bankrupt, okay? Does anyone know any famous celebrities that have gone bankrupt multiple times? Let's see. What did they say? Or you could add capital and revenues and subtract drawings and expenses. That's a lot of work. But that's what we were talking about just before. Well, not in the expanded. So in the expanded, all that we'd see in the expanded ledgers is the beginning capital balance, and if there was any additional investments in the company. Sorry, that was another thing I could have included on that previous diagram, is any additional investments in the company. Okay? So we would look at capital account, revenues, drawings, and expenses, and then we can determine our ending equity figure, right? Okay? So just like we talked. Oh no, those are. Oh, here it is. No, these are the answers, right? No.
No, those are the answers.
Yeah, those are on the. Okay, never mind. I guess I didn't use. Oh, those are all the answers. Yeah, that's start.